Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, joined as always by my co-host Lana Chen, and today we're diving deep into the Hartford Financial Services Group, ticker HIG, fresh off their Q1 2026 earnings report.
Great to be here, Hudson. The Hartford is one of those names that doesn't always grab the headlines, but delivers results quarter after quarter. This is a company quietly compounding shareholder value while navigating a challenging macro environment.
The Hartford reported Q1 2026 earnings on April 23rd. Revenue came in at $7.23 billion and diluted EPS of $3.04. Both came in just below Wall Street estimates, which we'll unpack thoroughly throughout the show.
The estimates called for $3.39 on earnings and $7.35 billion in revenue. A small miss on both lines. But context matters enormously here, and that context begins with understanding what the Hartford actually does.
Before we get into the numbers, let's set up who this company is and why the insurance business model is so powerful for long-term compounding investors.
Insurance is one of the most durable business models in capitalism. You collect premiums up front, invest that float, pay claims over time, and keep the spread. When underwriting is disciplined, the investment float generates returns on capital that compound for decades.
So Lana, let's start with the company background. Give us the complete picture on the Hartford, the history, the roots, and what makes this franchise special among American financial institutions.
The Hartford traces its roots to 1810, making it one of the oldest continuously operating insurance companies in the entire United States. It was founded in Hartford, Connecticut, where it remains headquartered today under Chairman and CEO Christopher Swift.
Over 200 years of institutional history. That kind of longevity in financial services is genuinely rare and speaks to the durability of the franchise through countless economic cycles and crises.
Absolutely. The Hartford survived the Civil War, the Great Depression, 2 world wars, and multiple financial crises. What you own today is a deeply entrenched insurer with brand recognition that took over 2 centuries to build.
Swift's transformation story is underappreciated on Wall Street. The Hartford of 2014 was a complex conglomerate with life insurance, annuities, and P&C all tangled together. The Hartford of today is a cleaner, higher margin, more focused P&C and benefits platform.
And that focus has driven enormous margin expansion. Operating margins have improved by several hundred basis points over the transformation period. Capital allocation has become far more efficient without the drag of capital-intensive life products.
Walk us through the 4 business segments that make up the Hartford today and how they contribute to the overall earnings and cash flow picture.
Commercial lines is the biggest driver, covering workers' compensation, property, automobile, liability, umbrella, and specialty products for businesses of all sizes. Then personal lines for individual consumers, group benefits for employer-sponsored life and disability insurance, and Hartford funds for investment management products.
The company has roughly 19,100 employees and a market cap of approximately $38.5 billion. Current price, around $139.70 per share. This is a large-cap financial services name in every sense.
CEO Christopher Swift has led the company since 2014. He came up through the CFO role, joined Hartford in 2010, and before that spent decades at Lincoln Financial Group. His strategic legacy is razor-focused. Exit life insurance and annuities, double down on commercial P&C and group benefits.
That portfolio transformation under Swift has been fundamental to the margin expansion story we see today. Leaner, more focused, and more profitable. All right, let's dig into 8 quarters of revenue data.
Q2 of 2024 was $6.47 billion. Q3 2024 came in at $6.71 billion. Q4 2024 was $6.8 billion. Then Q1 2025 was $6.81 billion. A clear, steady climb.
The acceleration continues. Q2 2025 hit $6.99 billion. Q3 2025 reached $7.23 billion. Q4 2025 was $7.31 billion, the highest quarter in our look-back period. Strong momentum.
And Q1 2026 came in at $7.23 billion. The 8-quarter trend is unambiguously positive. from the $6.5 billion range to consistently above $7 billion. That is meaningful top-line growth for a mature insurance company.
Year-over-year revenue growth for Q1 2026 versus Q1 2025 is 6.1%. For a company of Hartford's maturity and scale, that represents solid organic premium growth. Commercial lines pricing and group benefits expansion are the primary drivers.
Trailing 12-month revenue sits at approximately $28.8 billion. The stock trades at about 1.3 times trailing sales. That is a modest multiple for a business generating this level of earnings, consistency, and cash flow.
Now let's move to EPS and the earnings picture. This is where it gets interesting. Q2 2024 diluted EPS was $2.44. Q3 2024 was $2.56. Q4 2024 was $2.88.
Then Q1 2025 was $2.15. You can see the Q1 seasonality clearly. Insurance companies often carry heavier loss activity in early quarters from winter weather events. Q2 2025 snapped back to $3.44. Q3 2025 was $3.77. Q4 2025 was $3.98.
And Q1 2026 came in at $3.04 diluted against the consensus estimate of $3.39. That's a forward EPS projection miss of 35 cents, about 10% below expectations on the quarter.
The TTM earnings picture is genuinely compelling, though. Add Q2 through Q4 of 2025 plus Q1 2026, and you get approximately $14.23. The stock under 10 times trailing earnings is inexpensive for a franchise of this quality.
And looking ahead, the forward EPS projection for full year 2026 consensus is $13.46. FY 2027 estimated at $14.55. FY 2028 at $15.79. A clear and consistent earnings growth ramp expected.
At $139.70, that is a forward PE of roughly 10.4 times on 2026 estimates. The insurance sector broadly trades 12 to 15 times. Hartford looks like the value play in the group at these levels.
Now underwriting metrics and margins. For a P&C insurer, these matter far more than the gross margin line that tech or industrial investors typically watch.
The combined ratio is the single most important profitability metric. It is the sum of the loss ratio plus the expense ratio expressed as a percentage of earned premiums. Below 100 means underwriting profit before investment income even enters the picture.
The Hartford targets a commercial lines combined ratio in the low to mid-90s. That is best-in-class territory. Stack net investment income on top of that underwriting profit, and you understand why this business generates such strong free cash flow.
Looking at net margins quarterly, Q2 2024 was 11.4%, Q3 2024 also 11.4%, Q4 2024 was 12.5%, Q1 2025 dropped to 9.3%, reflecting elevated loss activity that quarter.
Then a sharp recovery. Q2 2025 came in at 14.2%. Q3 2025 was 14.9%. Q4 2025 reached 15.5%, the strongest margin quarter of the cycle. Q1 2026 moderated to 11.8%, consistent with Q1 seasonality.
The TTM operating margin sits at approximately 13.8%. For an insurance holding company, that is excellent. The investment income tailwind from the elevated rate environment is flowing directly into pre-tax income with very low incremental risk.
The margin trends show that Hartford's business model is working. Best-in-class underwriting plus growing investment income is a powerful combination for consistent profitability through different macro environments.
And worth noting, Q1 is always the weakest margin quarter for P&C insurers due to winter weather-related claims. The Q1 2026 11.8% net margin is entirely consistent with Q1 2025's 9.3% and represents a significant year-over-year improvement.
Let's shift to cash flow. Insurance companies can be extraordinary cash machines when underwriting is disciplined and investment portfolios are managed conservatively. Hartford has maintained both disciplines consistently over many years.
Operating cash flow in Q2 2025 was $1.29 billion, Q3 2025 delivered $1.84 billion, Q4 2025 produced $1.81 billion, and Q1 2026 generated $1.045 billion in operating cash flow.
Free cash flow in Q1 2026 was $1.01 billion after just $31 million in capex. Extremely lean capital expenditure requirement, typical for an insurance company where infrastructure capital needs are minimal versus claims reserves.
Trailing 12-month free cash flow is approximately $5.8 billion. The stock trades at roughly 6.5 times trailing free cash flow. That's an outstanding anchor for any valuation framework: growth, income, or value.
The free cash flow conversion story at Hartford is exceptional. Net income of $856 million in Q1 2026 versus operating cash flow of $1.045 billion. That 1.2 times conversion ratio reflects the quality of earnings here.
Insurance companies benefit from non-cash charges like depreciation and amortization that increase reported cash flow above net income. Hartford's D&A was $656 million in Q1 2026 alone, boosting the OCF materially above net income.
Let's build out the balance sheet picture now. For insurance companies, understanding the capital structure requires looking beyond standard debt and equity metrics to the reserve base and investment portfolio underneath.
Fortress balance sheet by insurance standards. Cash and short-term investments at quarter end were $4.39 billion. Total assets were $86.3 billion. The majority of that asset base is the investment portfolio held against insurance policy reserves.
Long-term debt of $4.37 billion gives a net debt position of about $4.2 billion. For a company generating over $5 billion in annual free cash flow, that leverage is trivially manageable. The debt-to-equity ratio is under 23%.
Total equity is $18.9 billion. Book value per share is roughly $67. The stock at 2 times book is in line with best-in-class P&C insurers and actually trades at a discount to Chubb and Progressive on that metric.
Interest expense runs about $50 million per quarter. Interest coverage is approximately 20 times. Zero debt stress. The balance sheet gives management tremendous flexibility for capital allocation.
And the investment portfolio, $63+ billion in total investments, is predominantly investment-grade fixed income. As Hartford reinvests maturing bonds at higher yields, net investment income grows quarter by quarter. That tailwind is durable as long as rates stay elevated.
The total assets number of $86 billion needs context. Insurance companies are required to hold large reserves against future claims obligations. Those reserves are invested in the portfolio, which is why insurers look highly levered on a standard balance sheet analysis, but are actually very well capitalized relative to actual risk.
Regulatory capital ratios, which are the correct lens for insurance companies, not standard debt to equity, show Hartford operating well above required minimums. That excess capital is what funds the aggressive buyback program.
Capital allocation is where Hartford really distinguishes itself from many insurance peers. Management has demonstrated a consistent willingness to return every dollar of excess capital to shareholders rather than sitting on it.
The company deployed approximately $658 million toward share repurchases in Q1 2026. Management has been systematically reducing diluted share count, which mechanically boosts earnings per share even in quarters where net income is flat or slightly softer.
The quarterly dividend is 56 cents per share, annualized at $2.24, giving a dividend yield of 1.6% at current prices. The payout ratio is only about 11% of trailing earnings.
That is an extraordinarily low payout ratio. It signals two things. First, the dividend is extremely well covered and at negligible risk. Second, there is enormous room for dividend growth as the earnings base expands. Long-term investors who buy today get compounding yield on cost over time.
Now let's look at what the analyst community thinks of HIG at these levels. Following the Q1 earnings miss, how has the street consensus evolved, and what are the key price target assumptions?
The consensus leans clearly positive. Of approximately 20 analysts covering HIG, roughly 12 hold buy equivalent ratings, 7 are at hold, and only 1 is at sell. The consensus price target is approximately $155, implying about 11% upside from current levels.
The 6 most recent analyst actions. B of A Securities maintained neutral on April 14th. Wells Fargo maintained overweight on April 9th. Cantor Fitzgerald maintained overweight on April 9th. Barclays maintained overweight on April 8th.
The notable rating change was KBW downgrading from outperform to market perform on March 30th. Keefe, Bruyette & Woods cited near-term reserve uncertainty and concerns about whether commercial premium growth could hold its trajectory through the back half of 2026.
And Citigroup maintained neutral on February 4th. Overall, the bias remains tilted toward overweight, reflecting the quality at a reasonable price setup that institutional money managers see in Hartford at current valuations.
Formal valuation check. TTM PE is 9.7 times. Forward PE on 2026 consensus is 10.4 times. Price to sales is 1.34. Price to book is 2.08. Enterprise value to EBITDA is 9.6 times.
Every single one of those multiples is below the broader financial sector average and below the P&C insurance peer group median. The 52-week range is 116.66 on the downside to 144.50 on the high end. We are near the top of that range today.
The beta of 0.528 is a critical data point for risk managers and allocation committees. This stock barely moves relative to the market. In a year with tariff volatility and recession uncertainty, that low volatility profile makes Hartford attractive to defensive-oriented allocators.
Let's run the competitive comparison now. When you look at Hartford's rivals in the commercial P&C and diversified insurance space, the valuation contrast across the peer group is genuinely striking and informative.
Travelers, ticker TRV, trades at roughly 10.8 times earnings on a $54 billion market cap. It is the largest pure-play P&C insurer and shows strong premium growth, but carries greater catastrophe exposure across its portfolio than Hartford.
Chubb, ticker CB, trades at 12.1 times earnings on a $112 billion market cap. Chubb is the global quality standard in commercial and specialty insurance. It earns that premium multiple because of superior underwriting discipline and geographic diversification.
Allstate, ticker ALL, sits at 9.4 times earnings on a $54 billion market cap. Allstate is the closest to Hartford on valuation, but is fundamentally a personal lines business with very different risk characteristics and growth drivers than Hartford's commercial focus.
Progressive, ticker PGR, is the outlier in the group, 18.5 times earnings on a $152 billion market cap. Progressive has earned its growth multiple with best-in-class auto underwriting technology and explosive premium expansion. These are very different business models in the same industry.
Taking the peer set together, Hartford at under 10 times earnings is clearly the value option. Whether that discount is warranted depends entirely on your view of workers' comp cycle duration and the reserve adequacy question KBW raised.
Now let's break down Hartford's 4 segments in more detail, because the business mix matters enormously for understanding the quality and sustainability of earnings across different economic and insurance market cycles.
Commercial lines is the crown jewel, approximately half of total revenue in fiscal 2025, roughly $14.5 billion. Workers' compensation is the flagship product. Hartford has maintained one of the strongest workers' comp combined ratios in the industry consistently over many years.
Group benefits is the second pillar, around 28% of revenue, approximately $7.9 billion annually. The segment experienced volatility during COVID-related excess mortality, but has normalized beautifully. Disability claims trends are favorable, and employer group retention is high.
Personal lines is intentionally modest, roughly 8% of revenue at about $2.1 billion. Management chose not to chase aggressive growth in personal auto during the difficult loss years of 2022 and 2023. That discipline protected the combined ratio when competitors were posting significant underwriting losses.
Hartford Funds is the smallest piece at about 5% of revenue, around $1.3 billion. The investment management arm provides recurring fee income uncorrelated to underwriting results. It is a nice diversifier within the overall business mix.
The segment composition reflects exactly the strategic choices Swift has made over his 12-plus years at the helm. Profitable commercial lines, stable group benefits, disciplined personal lines, and a complementary asset management business. Clean and focused.
Now the critical investment question. What is the bull case that gets you long HIG from current levels? Walk us through the 5 key catalysts that could drive the stock materially higher over the next 12 to 24 months.
Catalyst 1. Commercial lines pricing power remains firmly positive. Workers' comp and general liability rate increases continue flowing through earned premiums. Revenue growth has real runway even without volume expansion simply from rate.
Catalyst 2. Investment income is a multi-year tailwind. The Fed held rates elevated, and Hartford's $60 billion fixed income portfolio reinvests maturing securities at yields materially above the legacy book. This compounds every quarter without any underwriting risk.
Catalyst 3. Group benefits stability. Disability claims have normalized, employee benefits enrollment trends are healthy, and Hartford's strong broker relationships support premium retention. This is a steady mid-single-digit growth contributor.
Catalyst 4. Aggressive share buybacks. With $5 to $6 billion in annual free cash flow against only about $2 billion in capex and dividends, management has enormous capacity to reduce shares outstanding. That accretion to earnings per share is essentially guaranteed, absent catastrophic underwriting losses.
Catalyst 5. Potential reserve releases. If prior accident year loss development continues to track favorably in commercial lines, management has room to release reserves into income. That is a genuine earnings upside catalyst that consensus models do not fully credit.
Now the bear case. Every investment has real risks, and Hartford is no exception. 5 concrete concerns investors should weigh carefully before sizing a position in HIG.
Risk 1. Catastrophe exposure. One major hurricane season or a devastating wildfire event can eliminate an entire quarter of underwriting profit in a single quarter. Insurance companies cannot fully diversify away from weather risk, and climate trends suggest this risk is increasing.
Risk 2. Reserve adequacy, the opposite of the reserve release catalyst. If prior year development turns adverse in commercial auto or general liability, driven by social inflation and nuclear verdicts, Hartford could face reserve strengthening charges that compress reported earnings sharply.
Risk 3. Economic sensitivity. Workers' comp premium is directly tied to payroll levels and employment. If tariff-driven uncertainty or a broader economic slowdown reduces hiring and payrolls, Hartford's largest and highest margin product line faces top-line headwinds.
Risk 4. Claims frequency trends. Social inflation, the phenomenon of ever larger jury awards and settlement demands, continues to pressure liability loss ratios across the industry. Hartford has managed this well, but it is a secular headwind, not a cyclical one.
Risk 5. Market cycle softening. New underwriting capacity has been entering the commercial P&C market as profitability improved over the past 3 years. If competition intensifies and rates flatten or decline, combined ratios could drift higher, compressing underwriting margins.
Putting it all together, Hartford is a 216-year-old franchise trading at under 10 times earnings with a 20% return on equity, a dominant workers' comp franchise, growing investment income, and a management team that has returned billions in capital. The Q1 miss was a bump, not a break.
CEO Christopher Swift framed it this way: "We delivered solid first-quarter results, demonstrating the resilience of our diversified business model and disciplined underwriting approach across market cycles." The language was measured, which is appropriate given the modest miss, but the underlying business quality remains intact.
For investors who want financial sector exposure with lower volatility, a growing dividend, and a credible earnings growth story out to 2028, Hartford is a compelling name. Keep watching that combined ratio quarterly. It is the single most important leading indicator for this business.
This podcast is for informational and entertainment purposes only and does not constitute financial advice. The information presented reflects data available at the time of recording and may not be current. Always consult a qualified financial advisor before making any investment decisions. Charged Alpha and its hosts may hold positions in securities discussed. Past performance is not indicative of future results.
Ooh-wee-doo. That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.